Hey there, welcome back to the channel. I wanted to talk today about recession. You've heard it before, of course. Every article seems to be suggesting that we'll have a soft landing, and here we are approaching a recession. But now things have changed. In fact, they've really changed. You came here for the truth, so let me unveil that for you. I wanted to start with the earnings recession because we can look at recession in different ways. And here's the first thing, it's already over. Yes, that's right. Right before your very eyes, we've gone through a recession and come out the other side. The S&P 500's earning recession has officially ended. And so that's what they're telling us anyway. But what about the economic recession? Well, it seems to be a different story. And that plays a role in what happens in the stock market. Speaking of the stock market, you could see that it is concentrated in the hands of just a few stocks. In fact, we've never seen anything like this before. Contribution from the top 10 S&P 500 stocks, right now, 2023, it's like entirely the case. Like these small handful, the big names that you know, the Apples and so on, they're the whole stock market right now. And that's worrisome. That's not healthy. And we know that. And there is a bubble that has formed. Can you guess where that bubble is? Maybe some overvaluation, maybe a little froth, you know? You know when you get an espresso and there's that little crema on top? Well, that crema might be delicious. Might be the best part, in fact, of that. But it goes away rather quickly, doesn't it? So where do we find the parallel here in the markets? Care to take a guess? Well, I think you know. I really think you do. Tech regains momentum. You could see infotech as a percentage of the S&P 500 is at a 2023 high. These things are crazy. I mean, you look at the different ratios, you look at it in any different way, you look at PE ratios, in fact, and I've seen things that have gone off the charts, but nobody seems to be losing faith. Look at this. AI is the hot topic on earnings calls. You could see the AI mentions on conference calls for the Nasdaq 100 companies over the past few quarters. It's gone crazy. As soon as ChatGPT came out, this is all companies were allowed to talk about because they got more attention, they got more money, and that helps them to grow. It doesn't matter if your company has nothing to do with AI, you just say that you have that, and here we go. Mark Zuckerberg made a big mistake. You see, he called his thing the metaverse. If he would have called it the AI verse, it would have done well. I mean, that's unbelievable, but that's true. It really is true. And that's the kind of thing that we have seen. Now, in more recent cases here, that froth has worn off. And now investors are kind of saying, you know what, this AI thing, it wasn't, all that it's cracked up to be, and maybe it's going to take a longer time to get to where we need to be than some people thought. So, but what happens here in any stock, in any indicator, in fact, it usually goes well above or well below where you would think. It always overreacts. And just like if we were to take a stock market chart right here, we see there's an indicator called the Bollinger Bands. Everyone on my Money GPS Finance Live, we know about this already, but the Bollinger Bands are kind of like the oxygen that's there for the stock market. And if it makes its way out, which it does make its way out of those Bollinger Bands, it loses oxygen. And so it needs to come back within that. And this happens to be time and time again. And we see that everywhere. We could see it on different time frames, like short time frames and longer time frames. We see it in one sector or another sector. And we also have seen it throughout history. And so we know that these patterns do in fact repeat. It's never a good thing when we see froth. We don't want to, because it usually results in layoffs. So people get hired. Hey, maybe that person just got hired a few months prior, but they get fired. That's never a good thing. And this is the type of examples here that we see with froth. Starbucks stock rises 10% as US customers buy into pricier drinks. Is that real? Is that why the stock went up 10%? Come on, let's be honest. DoorDash shares jump more than 15% on guidance and narrowing net loss. Oh, they're losing less money now. The stock goes up in a day 15%. McDonald's revenue soars as it hikes menu prices. $18 Big Macs. It was one example they were showing here that people were paying $18 for a Big Mac, if you can believe it or not. This happens to be the luxury market. And that purple line there is Louis Vuitton. Louis Vuitton, they own all kinds of, LVMH. They own all these different luxury brands. They've come off the bottom, okay, clearly. But we'll see what happens, because I think it's interesting to follow that. And the luxury market is not necessarily doing as well as many expected, that it would be more resilient. But China has been really the determining factor there, because a lot of that money in like the European brands like that, they're not buying as much as they did before. The Chinese consumer is doing something different than the American consumer overall. Here we have it. There's still plenty of enthusiasm surrounding AI. Oh, that's right. There's no question about that. Look at Nvidia stock as one example. However, there's suggestion that it is overvalued. There's no question. People do believe that, but they say, well, it's the future, so it's not going to go down. What about Warren Buffett? What has he been doing? Well, seems to be that Warren Buffett is holding on to a record amount of cash. In fact, it is $157 billion in cash or cash equivalents. Here we have it. Apple versus Berkshire. And Apple is holding on to a lot as well. However, they have diminished that pile significantly over the last several years. So they've been using that elsewhere. And you just compare the two. All right. It is very clear that Berkshire, Warren Buffett, Charlie Munger, they feel that it's better to just hold on to, and by the way, they've purchased stuff. It's just they haven't made big purchases. Why? If they're going to make 5% on their money holding in cash or cash equivalents, why would they go out and buy a stock? Are they going to get 5% back? Most cases, not from a dividend. They're not going to get 5%. Are they going to get that from the market? They might say, maybe I'll get 5, but maybe I won't get 5. And what's rule number 1? Warren Buffett's rule number 1. Don't lose money. And so that's part of their strategy. This is called risk parity. I think it's important to understand that. I'm not saying you should do what Warren Buffett is doing. Look, they own a lot of stock. That's obvious. You can see what in the case of Apple, they own a massive quantity of Apple stock, but they haven't invested entirely into equities. So we see that, right? Look at it. Berkshire net purchases or sales of equity securities, and they're doing more selling than buying at this time. So it just gives us a little bit of an idea of what they're doing, and they've been successful over so many decades. During 2020, these guys are washed up, they're all but what happened in the end? Let's be honest. They proved everyone wrong. Evolution of initial unemployment claims after the yield curve inversion. So in this article here, they're talking about mass layoffs. They're talking about what's going to happen to the economy. And we turn to this, it's the yield curve inversion. And that is and happens to be one of the most accurate indicators of a recession. Why do we care about a recession? Well, generally what happens is that in a recession, you have the markets may come down. You may have layoffs that take place after this, while unemployment rises. This is a general fact, okay? Now, the stock market operates a little bit differently. It depends on why this is happening. It depends how steep that is. If it's 2008 and like banks are failing, financial companies are failing, and we got people, one by one are going out the door, that could be a different scenario than, what we've seen in other cycles too. I use the AI that I'm developing at this time, this GPT, I'll show you in a second, to basically build a more reasonable and sound explanation for what's going on. I don't think a lot of people are utilizing historical data in order to make sense of what we're seeing today. This happens to be one, and looking at it, the evolution of initial unemployment claims after the yield curve inversion. And what we can see is the months following inversion of the yield curve, we're getting very close to the point in time in which we can expect that there would be a recession called at some point. Okay, that's all it's saying. Recession could be deep, it could be shallow. They're telling us it's a soft landing, but we need to understand that that could be the catalyst. It all depends on how it goes. And I want to make that clear to kind of seal the deal on this video right here and now. You might be asking, what can I do? Well, for so many people, they're oblivious, unfortunately, because they're not going to get the latest and greatest information. These videos give you that. I've got Compass on my website as well. It's free to everybody. And what I want to do is get the people that are in my Money GPS finance group, which is a live session that's held on Fridays, and it's closed group. And what I do is provide a 30-minute to a 1-hour detailed presentation about new things that are happening. I also go into the stock charts. We look at that. We look at several different indicators and the things that are happening. So they are completely up to date on a weekly basis. And now I'm going even one step further, which is the GPT, which of course does not give us the be all end all. It's not like, okay, trade here, trade there. That's not what this is. This is so that we can understand what's happening, compare that to the previous cycles, and actually have the very real information that we can utilize today to make better investment choices. This one here, for now, I'm calling it Fire Your Financial Advisor. And it gets into all that depth. Like I said, you got to read, you got to know the information of the past. You got to do that on your own. But now we have something that will actually dig into it for us as well, so that we can kind of say, okay, I remember this, I know this information. Oh, and this is also saying the same thing. Now I have more confidence, and we want probabilities on our side. My mentor that taught me trading talks about probabilities all the time, every conversation. And that is something that I will not forget. And you can see that here. We want probabilities on our side. Anybody interested, click the link in the description for that. And we have the comment of the day. Thank you very much, as always. What's sad is what has happened over history. I mean, it's gone over and over again. The same patterns repeating. And he says that these economic geniuses go in circles and they never come up with anything that will permanently work. It's almost as if it was intentional. What do you think? Intentional or coincidence? I'll let you decide. I think you know where I stand on that. And if you really enjoyed this video, hit that thumbs up. And of course, as always, join me each and every day. I'll see you next time. Take care.